Most day traders treat pre-market high and low as automatic intraday support and resistance. They draw horizontal lines at the wicks and trade off them like they're structural. The reality is more nuanced. Pre-market sessions run on very thin volume, usually less than 5% of regular hours flow. Wicks at those low volume sessions are often single algorithmic prints, not real participation. When regular hours open and real volume arrives, those levels get ignored or sliced through immediately. Today, why most pre-market levels are fake, the volume threshold that separates real participation from noise, and how to use pre-market context without trading off the wicks. Here's the framework. A pre-market wick at a price with only 1,000 shares of volume isn't a level. It's a single trade that happened to lift the offer or hit the bid. When regular hours open, no participants remember it because no participants made it. A pre-market wick at a price with 100,000 shares of volume is a level. That's real participation, real positioning, real institutional commitment. The threshold is roughly 10% of the stock's typical regular hours volume at that price. Below that threshold, the wick is noise. Above it, the wick is a level worth watching. The number on the volume bar is the entire filter. Watch this in a synthetic intraday chart. A trader sees the pre-market high at 102 on the chart and draws a horizontal line as resistance. When regular hours open, price approaches 102, they go short, expecting the level to hold. Price slices straight through to 108 without pausing. The resistance didn't exist. It was a single 1,000-share print at 4:30 in the morning that the regular hours market never even noticed. The trader was trading a level that, structurally, was never there. They drew the line because the wick was visible. They didn't ask if the wick had any participants behind it. Here's the rule. Before treating any pre-market wick as a level, check the volume that traded at that price. If the cumulative volume at the high or low is less than 10% of the stock's typical regular hours volume, usually visible on a volume profile or by summing the pre-market bars, discard the level. Treat the wick as noise. If volume meets or exceeds the threshold, the level is real and worth watching during regular hours. The same chart structure with different volume backing produces totally different probabilities. Volume is the only filter that distinguishes structural from cosmetic. Now with the volume confluence. Same pre-market high at 102, but this time the volume at the price was 150,000 shares, well above 10% of normal regular hours volume. That's real institutional participation, real positioning, a level the regular hours market will respect. When regular hours open and price tests 102, it gets rejected sharply. The trader short at the level catches a clean move with structural backing. Same price, same wick on the chart, completely different probability based on whether the wick had participants. The filter is the volume number, applied ruthlessly. In practice, use a volume profile on the pre-market session to see where real participation occurred. The high volume nodes from pre-market are the real levels that will likely hold during regular hours. The wicks above and below those nodes, if they have no volume behind them, are decoration. Use the pre-market for bias and context. Which way is the stock leaning? What news drove early flow? But trade only off the high participation levels, never the cosmetic wicks. The discipline keeps you out of the trades where pre-market noise pretends to be structure. So, pre-market high and low are not automatic levels. Thin pre-market volume creates wicks that look like levels but have no participants behind them, and regular hours respects only the levels with real volume. Use the 10% of normal volume threshold to filter. Above it, the level is real. Below it, it's noise. Subscribe for the full method and trade your own plan. Education, not financial advice.